Okay.
Yeah, you can go ahead now.
Okay, great. Okay, good morning, everybody. This is the Option Professor of OptionProfessor.com, and I'm going to be going over my views, my expectations, my opinions here today. Again, what we are sharing is our views and our opinions. Anything about doing actual trades or anything, you got to consult your brokerage firm and talk about suitability and risk tolerance and all that kind of stuff. So we're not giving out advice here. We're just giving you our views and our opinions on things that are going on. All right, I'm going to go over a lot of stuff here today because there is a lot of stuff going on. And again, we have been, in my view, quite accurate with our forecasts and our information. Everything from growth to value switches to what the dollar and the S&P and the treasuries are going to be doing and a bunch of other things. So I'll just go over this stuff and give you the views. Okay. All right. So when we talked about the S&P 500, right now we're at 4,000. Okay. We did have a gap down today. So what we're doing here today right now is we just filled that gap that happened on the opening. So we'll have to see how it actually goes home. But again, here's the big story. The I look at things at 20-year, 5-year, 1-year, and 1-month basis. Okay, and that gives me 4 different time frames. So here you go and I'm using 3 different simple moving averages. So red is 12, green is 24, and the other one is 36. As you can see, the 36 going back on the 20-year graph, it is uptrending and it is still uptrending. So again, even though we did break down to 3,500, we're back above 3,830. And as long as we're above 3,830, again, it's in a bullish situation. Okay, so that's a big thing. The problem is the red line, which is the 1 year, is pointing down and comes in at 4170 ballpark, which I think is in the same neighborhood as the 200-day moving average. So there could be quite a bit of problems up in that neighborhood if it gets up there. Now, the other problem is obviously where the former high was of 4350. So those are where we're getting the numbers of 4175 and 4350. That is the resistance on the rebound rally. Again, you won't find the market going too far with the red line pointing straight down like it is, not even during the rebound after actually the last time it had this kind of trajectory on the 1 year was actually back in 08. So again, that trajectory is problematic for the market. Okay. And again, the longer you stay under 4175 every day, those averages are going to be pointing down because it's a moving average, right? So every day you're underneath the average, it's going to obviously go lower. So those are problems in the market. And that's why we're in a window of 3,800 and 4,200. And that's the window we probably are going to be in. We break out of that window and it's not like a false breakout like we saw back there at 4603. That was a false breakout, but it never broke the red line. It just broke the green. And so the bottom line is that's why we are thinking that this is a reversion rally as opposed to a get all your money back in and go to bed rally like it was after 08. See, after 08, it was just put the money in there, leave it alone, let time do its thing. Okay. Even after 2020, where they dunked it underneath the blue line for a couple of months, once it got above the blue line, go to bed, leave it alone. And you woke up a few years later, and because they printed so much money, it went up to 4,800. Again, that balance sheet is going to be coming down, and it's still at 8.7 trillion, which is almost double what it was before. So there's a lot of QTing to be done. And some people speculate they're not going to do it all. And the terminal rate is 3%, and now it's 5%. We're not into that kind of stuff. We're into the thing of what is happening and following the trend. The trend is they are doing QT and they are raising interest rates. Those are the trends. Guessing where they're going to do this and that, that's a short-term gambling game, which is obviously perfectly legal. Okay, so there you go. And your RSI is right around 50. So this is a very critical juncture for both RSI and the market. We're right around the 50 number. So if we can if it starts rolling over from here and takes out 3830, it's going to be Katie bar the door on the downside. Likewise, if they can keep it up here and get it going further, you could easily be looking at a situation of what? Of, going up towards that 4,200 and maybe best case 4,350. Let's see what the 5-year is telling us. Okay, 5 years coming up right against some of these numbers here, as you can see. So there's some resistance as we speak at 40.24. So let's see if we can get through 40.24, because obviously that's another resistance zone. A lot of people don't know that. And Harry's stuff he was just mentioning, he was showing that we're coming into some resistance on things too. So this could be a place to do selling calls against some of the things that have run up. If they're, like I said in my newsletter, if you're on the Titanic, it might be time to what they call shuffle the deck chairs. Meaning if you're in the arcs and those kind of things, you got a huge rally in some of that stuff. And that might be time to make some adjustments, what they call de-risk, and don't look a gift horse in the mouth. So the bottom line is I would be looking at some of those things at in this neighborhood here. And again, after this neighborhood of 40.25 comes the neighborhood of 41.75, 4,100. And then after that, the neighborhood of 43.50. This thing did make now here's another reason why we were very bullish in October, because again, the VIX was at 35 and you see how far away you are from the moving averages. Okay. You're tremendously far away. If I go back to the 20-year, look how far away you are from the moving average. Moving average is at 4,200. You're at 3,500. That's 700 points underneath the moving average. This is called reversion to the mean, and it was pretty darn obvious. Okay, so the bottom line is we've already had that reversion to the mean. And if you want to know why it might fail from this little bit above 4,000 area, that's the reason staring you right in the face. Also, you see the RSI is right at 51. The other one's at 51. So this is a neighborhood. If it starts rolling over, again, that RSI starts getting back underneath 50, and all these happy faces that were printed last week, and all these, people calling up their clients saying, hey, the lows are in, everything will be fine. I told you not to sell your stocks, and, you got to be in there all the time or else you're going to miss these big moves, all that kind of talk. That kind of talk looked very good last week. If this thing starts breaking down, and like I say, let's figure out where, again, 38.30 for sure. And you can see these number here come in at 38.24. So it's 38.50, 38.20 neighborhood, very important neighborhood. Another one would be the green line, which is 39.08. So again, if it does start rolling over, that's something to look at as well. On the 1 year, where would we get a signal? See, again, a little bit on the overbought side versus the averages, right? So this is the kind of deal where it either, it spikes up to 41, 42 without stopping, or it comes back and does a little bit of a backing and filling. Again, where's the red line here? 38.58. So you get the idea where I come up with these neighborhoods. I'm using the moving averages and how they look on a variety of different time frames. I'm not pulling them out of my ear. I believe in the moving averages because they're based on price and time do not lie. People lie, but price and time do not lie. So that's why I like to look at the moving averages. Okay, they give you an idea of the trends. So there you go. Another instance where you could get a pullback, and look at your RSIs up here at 60. So again, it's a little bit extended. So we'll have to see. 40.25 would be obviously a line of resistance. And then, of course, if it gets through that, it opens the door to the higher number. On the 1 month, have we gotten a sell signal yet? No, not really. So again, if you're short-term trading, you can see your RSI certainly did not keep going higher when this went higher. So that's a bit of a divergence, right? A little bit of a divergence. And the red line is the key here, because if it rolls down, you'll be in good shape on the sell side. So looks like a break under 39.80 would be a pretty good signal that maybe it's going to have a correction. And today's low is 39.75. So today's lows, you start taking that out, that would probably be a sign that we're going to get a decent correction. And again, we had 39.08 on one, you got 39.20 here. So on a short-term basis, 39.20, 39.08 better hold. On a longer-term basis, 38.20, 38.50 better hold. So those are your numbers to work with. And that's how the S&P looks. Let's look at your NASDAQ, because obviously that went nuts, like Harry was showing on SMH, but a lot of those, again, they got resistance too. Let's go out to the 20-year, and I'll show you what the text looked like. Again, with the people that we talked to, we explained to them we've had 3 changes in asset allocation on the ratio between growth stocks and value stocks. The first change was November of last year, coinciding when the Fed started hiking. We said, go out of your growth and go into value. Value are staples, lower PE, good dividend payers, those kind of guys. Okay. Then we got another turn in May where it said, get out of your value, go into the growth. And obviously we got a very big rally from May to August. And that obviously coincided with a very big move in tech. Now in August, we got to switch again out of growth into value. And since that time, you had a huge drop in tech and growth. And again, the value stuff like banks, industrials, energy, they've all had some very, very good runs. So those switches have been very accurate. And again, they still remain intact as far as we can see. So value is supposed to be the better place to be. If you remember after the 2000 crash, tech obviously was going nuts going into the 2000 crash, right? The dot-com boom. After that, years and years went by when value outperformed tech. We suspect we're entering into that phase right now this year. So we'll have to see. Again, people are going to want to get paid because if the stocks aren't going up very much, there's no reason to hold on to them unless you're getting income. And that's what value does. It pays income. Not only that, with T-bill rates being higher, you got a pretty good shot that you're going to get what? You're going to get more pay because there are things called dividend growth things. I'll get into those in a couple. Okay. So where are you here now? You are, you can see obviously the NASDAQ has nothing but trouble ahead at 320. It has not even been able to get above the blue line, which comes in at 303. So again, 303, you've got some resistance. And then at 320, you're running into more resistance. And then up there at the green number, your resistance again is up at 332. So you got some resistance above. RSI still under 50. So again, it's at 46. So you're either going to be looking at a situation where this plays a mean game of catch up and starts pressing 303 and 320, or it's weaker than everything else. And it's going to be weaker if the thing rolls over. Let's look at the 5-year, see what it's telling you. Again, you know, it is a situation where it could pop. Right now, the red line's pointing down. That's not a good thing. So the red line pointing down, it comes in around 280. This thing starts closing under 280. I wouldn't consider that a positive. So there's a good line in the sand there, 280. And then, of course, up ahead, there's your 300 number that we talked about, 303, 300, right in that ballpark, right? So there's some resistance. And again, it failed at that point back in the August rally. So keep an eye on that as a ceiling as well. And again, the RSI is under 40, under 50 on there too. What's the 1 year telling us? Probably they were overbought. Yeah, a little bit. And again, they all come in here at around 272, 274, 272, 274. So that's going to be your big support zone that you do not want broken. So if you are bullish and it pulls back, that'd be a neighborhood where it might be time. Now you got a gap there, and I don't know if it's going to try to fill it, but it could. And that comes in around 265 to 275. So there's a big gap there. And then you got this moving average right in the middle. So if we do go into that neighborhood and you're bullish, you definitely don't want to get in underneath those numbers. And then on a 1 month, have we gotten a sell signal yet? Let's see. No, nowhere near. Okay, so again, this thing you can pull back here. And again, there's a gap I was talking about, right? Boom, boom, boom. Now, like Harry Boxer was saying, it doesn't have to fill right away. It might fill at the end of January, might fill in February or March. But they tend to fill because, you know, you had a gap here, right? Boom, it filled. Any other gaps? I can't see. There's a gap over here, and it gapped down. Well, it gapped up, and then, of course, it immediately gapped down. So these gaps tend to get filled, and there's another gap here that gapped down, then came back up. So, you know, again, they do get filled. They don't have to be filled immediately, like we were saying in the other broadcast. Okay. So there you go on the NASDAQ, resistance, you know, your 300, 320 ballpark, 330, and your support looks like that 280 and then down further towards 270, 265. All right. Let's go to the over the counter, you know, the small caps. People love small caps because they're saying they're not affected by the dollar. Their valuations are very, very low. And so there's people who've been very keen on the IWM, the small caps, right? And so, and mid caps as well, but small caps. Now here's very interesting because you're right here in the neighborhood of support. And look, this is a real log jam. So this could be a very interesting place to start really thinking about getting going on it. Your blue line has been rising now, and it comes in at exactly 186, which is just above where we are. So this is a break of that number, which obviously wouldn't be a good thing. And then, of course, you got the red line coming in at 190. So 186, 190, that's your neighborhood of congestion. If you get through the neighborhood of congestion, it does open the door. But that red line is pointing straight down. And, again, you're not going to find too many circumstances when it's pointing straight down and doesn't have to turn up for you to get a substantial move. So again, if you're going to get a substantial move in the small caps, you got to get above 190. You got to stay above 190. And then if you do that, then people could say, hey, it was 250. It came down to the old low, the old highs of 2020, right? It held the old highs of 2020 ballpark figure. Okay. And then basically it's back on its bike. So a very key point here I see for the NASDAQ, for the small caps. And where's your RSI on it? Your RSI is right at 49. So we're right back to sea level on the RSI on a lot of this stuff. And the question is are we going to get that big rally to 42, 4,300? 41.75, whatever. And if we are, this stuff is going to break through 186, 190, and you're probably going to go up and try to start testing even 200 or better. And if it can stay up there and turn the red line up, then 2023 might be a good place to be in the small caps. But right now, again, it's hit a neighborhood of congestion. And so far, it does look like it's backing off just a little bit. All right, let's look at the 5-year real quick on small caps. Again, constructive. But again, the red and the green are all under the blue, so that's not constructive. So anyway, if you come back down, like we said, 175, 170, and then basically you'd like it to stay above that 180 if you could. On the 1 year, a little overbought. Again, your 180 is support, and the 175, 170 again. So that's where you are. Have you gotten a sell signal? Probably not, because it was so overbought. No. So again, there's no sell signal. You got another gap there though. And so again, the question is it going to fill it soon, like Friday, if the PPI reports and other reports? Is it going to fill it by mid-December, if in fact the CPI number and the unemployment report shows a lot of strength, and the Fed puts 75, the Fed puts 75 back on the table, we're going down. Because if they put 75 back on the table, one of the reasons this thing went up is they went from 75 on the table to 50. So they repriced everything from 75 to 50. And that's why you get the big jump, the short covering, the I got to get in with my sideline money. That's because they've repriced the 10-year, the Fed hiking from 75 to 50. If they go the other way, using common sense, it could be trouble. Speaking of the 10-year note, let's put it up there for you. This is interest rates. And again, we talked about this to people who are reading our stuff. We told you about this. Again, when you get way away from the moving averages, you're going to pull back. I mean, look how far away we are from the moving averages on the long-term graph. I mean, this thing is way up here at 450 on the 10-year almost, and the moving averages are all down in these neighborhoods. But even on the 1 year, again, you were way up here. Remember, this was in September. You were way up here, and it came back towards the what? Towards the mean, and then it went back up to a new high. Right now, this is the first time we've broken underneath the blue in the last long time. Actually, the one I'm talking about more is this June high point, because again, there seems to be some correlation, or not correlation, but some similarities between the stuff that happened in June and July and the stuff that happened recently. And I'll show you one of them's here. The June, July high on interest rate, high on yield was here. And then into August, we had a big pullback, okay, where it broke the blue line and everything else. That gave you the rally of 36.50 to 43.50 on the S&P. Okay, it also gave you a break in the dollar from 109 down to 104. Very similar to what we see now, okay? Then, of course, it got on the bicycle and went way up again. So again, could we come down here and let's see where this pullback ended. It ended right here off the March high point. So if we were to come down here to the June high point, we could be going down towards 340, 350. And if we do that, that would coincide with the rally going up towards the 4,100 to 4,300 area. Okay. We'll have to see, because right now it's starting to go back up. On a 1 month basis, what has it done? See, still looks pretty lousy. So the bottom line is the setup we were talking about that's similar to, and don't forget the other similarity here. We had a Fed meeting in July, and then we didn't have another Fed meeting until September. And I'm going to go back so you can see that. Okay, here we had a meeting in July, right? They did what they did in July, right? And then we didn't get another meeting until September. And then once they met again, there you go, back on the bicycle. Okay, so we don't have another meeting until February 1st after this December meeting. So that's why this December meeting is very important. Again, because after that, they're on hiatus until all the way till the end of January, beginning of February. And a lot can happen during that period. So again, a lot of our opinion is there are a lot of similarities between the June, July, and the rally into August, and then the big drop because the Fed comes back and they start hiking again. So let's put up the chart so you can see that again, because that could be a very helpful thing for you to keep an eye on. If it's going to be a repeat. Right now, it looks like a repeat because your VIX has gone from 35, down to 22. Okay. So again, we're looking at if it's going to be the same. You see the low was here, then there was a low here, then a new low, then a new low, and then the red line starts turning up and it goes up. Then it comes back and violates the red line as it did right here. And then once it got above this, can you see it just was off to the races? So that was where our buy point was, 38.20. And so after 38.20, you can see it's been boom, boom, boom. Now on the pullback, will there be a pullback? Well, in July there was, and we pulled back from this big thing back to the red line. So the red line here now is at 38.30. So you understand why we were thinking it might pull back towards 38.50? Because again, it did that back. And then you go on the more major run. So possibly, if we're fortunate, if you want to get long the market at a better price, you'll get a little pullback here. And this would be a neighborhood if you're going to consider getting in there. And then, of course, using this as a threshold of support. The dollar, let's show you that real quick. Because again, the dollar and interest rates really, got this thing going, no matter what anybody says. Okay, so you can see here, again, reversion to the mean. You see, way, way overbought on the long-term graphs. Okay, way overbought. Okay, so on the 1 year, you got the sell signal pretty much up in this choppy neighborhood of 113. Yeah, again, sometimes they like to do this. They run it up, get everybody out of their short positions, and then they tank it, right? I don't know what that was all about. Want to maybe take a look at those down there. Anyway, this thing comes in. Once it broke under 111, can you see 111? Once it broke under 111, 112, that was the real sell signal for us. And then basically right now, where is the support zone? If I go to the 5 year, I think you'll see some moving averages coming in. You see, this is why we're thinking it might stop here. So 106, where it hit, kind of a support zone. And the RSI is right around 50, I think, too. Well, it's underneath 50. Now it's at 48. So if the RSI gets back above 50, you start getting back above 108, that correction could be done. Everybody who got short, and of course that might hurt the stock market as well, because again, they don't like a strong dollar. So again, reversion to the mean. That's where we're talking in our newsletter about reversion to the mean. You don't want to get caught buying a reversion to the mean, a rally, because again, if they put it back underneath, you're going to go down with it. But you can use a reversion to the mean to get off of lousy stocks that have had some kind of a new life to them, rotate into maybe some more into the value sector. And then, of course, on that sector, maybe sell some calls. So you get some dividend income and you'd get some what? Cash flow coming in off the calls. Again, not a strategy for everybody, but something to investigate. Also, if you wanted to collar them, you'd sell the calls at that point and buy puts, and that would stabilize your principal. If you don't understand all this and you'd like to know more about them, because obviously I talk very much as if I've done this a million times, because I have, but I can explain it to you in layman's terms and slowly until you get it. And, I'll give you the contact information at the end of the broadcast, and you could get a hold of me at that point. Okay, remember we talked about the different sectors like, growth. First of all, let's look at some of the sectors that are having trouble. This is tech, okay? Now let's look at tech and you'll understand what I'm talking about. Okay, see, tech is just now getting back above the blue line. So again, as long as we stay above 130 on this, okay, I would think that it's pretty good, okay? But the RSI is right at 50 as well. But, as long as it stays above 130, it could be good. Another one is consumer discretionary. And this is another one that doesn't look so great, right? Because it's still way under the blue line. So those things are called growth, right? Consumer discretionary and tech. Now let's take a look at some of the stuff I'm talking about, like dividend growth. It's not as exciting as tech, as far as, they're not going to go through the roof every day, but you're going to get some cash off of it. And dividend growth means you got a good shot at maybe getting more cash every year. And you can see this is where the money seems to be going. Because on the 20-year graph, you can see it's above the blue line. On the 5-year graph, let's see what it looks like. It's back above the blue lines. So you can see this is where the money has been going into as it comes out of tech and growth. Let's look at another one here for you. Value. And you can see again, back above the blue line on the 5-year, but I think on the 20-year, it's also looking fairly good. 20-year. See, that's way above the blue line, right? So this is where the money's going. This is where the money's going. And again, they're rebalancing. These money managers that have to track the S&P, again, they seem to be switching into energy, into banks, into industrials, into materials. That's where the money's going. And where is it leaving? It's leaving tech, and it's leaving consumer discretionary. And there's a good example of what I'm talking about. Okay. Now let's take a look at some of these other ones that we were talking about in the, well, let's talk about some of this international stuff and see if there's anything going on here. Okay. Now this is emerging markets. Of course, China is a big part of emerging market. Let's take a look and see if anything's going on here yet. Might just see, like I say, we're thinking this is a reversion to the mean. This is called getting off the canvas, way oversold, and you're going to try to get a reversion to the mean situation. But you notice if you're going to really make a lot of money on it, the red line is pointing up. If the red line's not pointing up, even if you get a rally, okay, like you did here a little bit, it's not going to be able to sustain unless the red line is really turning up like it did here. So this was in the July after the crash. Boom. Okay. Since when? Since November of 2021, when we talked to people about going into value and out of this other stuff, it's been a down situation. Okay. So on a short-term basis, obviously it has been a turn. And there you go. So if you're going to short-term trade it and play it for the bounce, you want it above 36. As long as it stays above 36 on this thing. And there's gaps there, 1 and 2 and 3. So you got 3 gaps there. Likelihood it might pull back is, better than even. But again, 36 is one of the key numbers now to keep it going. And especially the direction. You want the direction of the red line pointing up. Let's turn towards, again, we were showing you Mexico. Again, when they reshore this stuff or they look for other places to get things done, Mexico is right next to us here. And we don't have to go over 19 oceans to get to the stuff. So maybe Mexico is going to benefit from the transferring of supply chains. It makes some sense, but it's also had a very big run. Of course, we loved it at the 40, 45 mark when the red line turned up. And of course, we're enjoying it up here, but we would be hesitant to add or do anything here because it is kind of extended right now. Okay, but it is something on a pullback that probably has a pretty bright future because on a 20-year chart, you can see it does look pretty good. So again, this would be a buy the pullback type of thing, unless we break underneath the 44 number. So there's your line in the sand there. Okay, and then we look at Brazil, which obviously just had a new election and they're all over the place, but they are rich in natural resources. They got a ton of grain, they got a ton of metals. It's a big country, and you can see if it gets moving here above 35 and then 40, there's a lot of real estate above. So we're eyeing this one up. Again, the political situation over there is a little volatile, and the integrity of the place over there can be a little suspect. So we have to be careful. But again, this stuff here does look like it may have some potential. We're keeping an eye on it. The other stuff is all reversion to the mean. I'll put up a European one. There's a couple of things you can look at in Europe. There's a Vanguard ETF on Europe. You can see reversion to the mean at best, right? And then there's a banking one. Their banks also will make money when interest, just like our banks, they make money when interest rates go up because they pay you nothing on your savings. And now they can take your cash and invest it and get what they call net interest income. And net interest income is huge to these people. Now, this thing is a reversion to the mean kind of deal, but we did like it when it was way down, and it's given us a very nice rally, as you can see. Double bottom at 13, you get above 14, you get in there and you're up at 16. That's a 20% jump almost. That's not bad. So bottom line is that, but again, that does look a little bit extended right now as well. And if that dollar has bottomed at 106 and it's going to move higher, and these rates are not going to take out and go down towards 350, 340, 360, then obviously this rally may pause. So keep an eye on the 10-year. And again, I'll give you a quick idea on that 10-year again. Hang on a second. And the VIX. VIX hit about 22 and change. It's in the 23s, 24s. It starts getting back above 25. That's not a good thing. On a 1-year basis, if this thing gets back above 405, you start seeing yields above 405. Again, that would be an indication that maybe these yields aren't going to back off. And again, this recent low here at 380, you take out 380, it opens the door down towards this high over here, which is in your area of 350. Okay, so there you go. Best case scenario here might be a move down towards 320. Because again, when they did pull back that one time, it did go down to as low as the blue line neighborhood. So we could see as low as 320. If the Fed only goes 50 points and the CPI numbers start turning and the unemployment starts going up, again, going back towards 320, 340 is not out of the question. Right now, though, those numbers haven't come out, and they may not come out that way. And the whole world is betting they are going to come out that way, which is kind of like the whole world betting we were going to get 75 basis points a week ago. And then once they took that off the table, you got a big rally. Well, if they put it back on the table, you got to figure there's some vulnerability here. So a real key to see what these numbers come out at coming forward. And again, when you look at the CPI drop, used cars are coming down. Well, how weird was it that they were up in the first place? Your entire lifetime, what'd they tell you about used cars? They depreciate. So the fact that they were appreciating, wasn't that weird? Well, weird doesn't last. Weird doesn't last. Okay, let's look at a few other things here that are kind of big to me, because this is the stuff where the dollar and interest rates may have a big effect. And that, of course, we already talked about was the what do you call it? The the international markets. Here's a couple of other ones. These gold miners. Again, 20-year graph, yours is reverting to the mean. You got nothing but resistance above here, okay? Nothing but resistance above, okay? On the 5-year graph, again, resistance above, okay? And on the 1-year, big up move, gaps underneath. So possibility for a pullback. Again, if yields and dollar go reverse their moves, likelihood this is going to reverse its move as well. But it does seem like it is trying to turn into something more of an uptrend, but it's still very choppy. The red line turning up is very positive. So the longer that red, the longer we stay above on GDX, above 24.75, the longer we do that, the longer this red line will start moving up. And when the red line moves up, it tends to market move up. Got a couple of the ones that I mentioned in the other broadcast. This is First Majestic, again, trying to turn up here. Got a big pop out of it though, so we were very happy. We were taking shots at it down here. And then the other one was Goldfields. GFI. Again, another one we were very happy to take our shots at once it got above the red line. And there you go. Okay, so there's your metals there, and Freeport McMoran, again, another one. Again, you get above the red line, you get long, boom, there you go. Okay, and again, the direction of the red line, very important, because even if you penetrate it, if it gets right back above it, boom. So that's why when these red lines are pointing down still on some of these markets and you've had a rally, that's not good. Because when they're pointing straight down and you've had a rally through them, those rallies are suspect until the red line starts turning up. And since we're dealing in price and time, there's two things that have to happen for those red lines to turn up. You must stay above them and you must sustain the price above them. And if it's a real bear market, it's hard to do that. That's why they fall apart so quick, the bear market rally, because they don't have the character to hold their gains. And ergo, they get right back underneath the red lines. Okay, so that's those two there. Again, we are looking at Cleveland Cliffs as a possible trying to turn around a little bit. Again, here's the reason I'm kind of looking at Cleveland Cliffs and steel, because if you look at the 20-year graph, if they get going, okay, there's a lot of real estate above. So again, Cleveland Cliffs getting above 1521, which it's at right now, is a very good positive. RSI getting back above 50 would be a very good positive. Getting back above these red line here of 1950 would be another positive. So getting above 1525 and then above about 20 bucks, it would open up the door to all this real estate up here. Same thing with steel. And again, aren't we supposed to be doing infrastructure? Aren't we supposed to be fixing our roads and bridges and blah, 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 right? Well, if we're going to do that in the next year or two, they're going to need this stuff. And if they need this stuff could fly. So again, you want to know a couple of things that I'm looking at? I like this because I think my risk on the downside is pretty limited. And I think if it gets going, I'm going to get well paid. Not unlike, I'll show you a couple of ones that I had the same opinion on only months ago and years ago. This is Halliburton. Okay, you see it hits $5. It gets above the red line. I'm interested. Why? Because we're going to need oil. These electric cars, come on. Once the components of the batteries went way up, they're not affordable anymore. You know, so if they're not affordable, that means everybody can't buy them. Plus, you got to have the filling stations and all this stuff. So the transfer from fossil fuels to electric, much longer runway than people thought. And that's why the Teslas are tanking and the charging stations tanked and everything else. Because again, the runway is going to be much longer. I said that to myself. I'm looking at the freeways and I'm going, all these cars are going to be electric in a short run. That doesn't seem likely. And it wasn't. And then the main thing is the battery, which has cobalt, which has lithium, which has nickel. And these things have gone through the roofs, which means the batteries went through the roof. Okay, so here you go. Halliburton, obviously another deal. If you look at the 20-year, can you see once it turned up, there's a lot of real estate above, right? Just like those metals that we were just mentioning. That's why I like this kind of stuff down here. Okay, Schlumberger. Again, lots of real estate above. Gets above the red line at 20. You know, boom, boom, boom. Come downs and tests it. There's your other buying opportunity. Now you should just be enjoying the ride. Is it going to pull back to the mean? Possible. Is it going to be resistance at 60? Possible. Right? So again, That's why you have to try to get in at a good time. I mean, that's the story of investing, right? And then, of course, if you're looking at some of the other ones that we watch, Suncor up there, I think Elliott Management with that Paul Singer is a big holder of this, I think. But again, once you got above 15, 16, you got your buy signal, came back down towards 30, another buy signal, and it still looks reasonable. Some real estate above. Another one is this guy here. Again, once you got in at 4, 5, and 6, you ride it. But again, you have to look at a sector, and you got to get into these sectors when they're out of favor, but they're not going out of business. Are steel stocks going out of business? Are silver and gold stocks going out of business? We don't think so. They're tangible assets, right? This stuff is an asset that people use. So they're probably not going out of business. When they go way, way down and they start turning up, that's when you can make some money. Another one is MRO. You get your buy signal at $5, you add, pulls back to the red line, you buy. It's up here, you're enjoying it. Is it going to revert back to the mean? It's possible. You got a double top up there, and oil's having some trouble. Let's put crude oil up there. I mean, I'm not going to fight the tape on oil, but I'm also going to be keeping my trigger finger handy because the whole world is long this stuff. And all I hear is 120 oil next spring, 120 oil next spring, well, we're at 87. And again, if you look at the 20-year graph on it, again, it's right up here. You see when I said there was some resistance? There's some resistance right there at around 94. Okay, so you notice we haven't been able to get above 94. That's where I come up with that number. Okay, if we get above that number, believe me, it will open the door for 120. Lord knows, I don't know, it's not going to 150. But if it can't get through one, and the red line is still moving up. So again, I'm not bearish on this stuff, but I will tell you this, is that until it gets above that 94, I'm not going to sleep too easy that it's definitely going higher. Okay, on the 5-year, again, you see all the resistance on the blue line right around 100. So you see where I'm getting these numbers, 93, 94, and then up there, 98, 100. That's where I'm getting the numbers from. Okay, on the 1-year graph, again, looks pretty good as long as it stays above 85. This thing's at 87. You start seeing this thing underneath 85, and I think something's changing. The red line up here comes in at about 88.5. 88.5. So again, getting back above 88.5, a positive. Getting above 93, 94, a positive. Getting above 100, really positive. Okay. Now, are they pointing in that direction? Kind of. So it could happen. But again, where would the floor get let out? Looks to me like if you break underneath $85, that might be a case of the floor getting let out. And the longer it stays now under 88.50, then that means the red line might turn down. So got to be a little careful with oil. Again, they are good companies. They pay great dividends. They are earning lots of money. So there's a lot of positives about them. The one on the on more of the natural gas and stuff, a couple of them that I look at here, Williams companies. And again, that's been a good one for us, right? You can see on a 1-year basis, it's had a big run. And there you go. So it's back above the red line. So this is one that we would be kind of keen on. And then the other one is RRC, which is kind of a popular name out there, Range Resources. And as you can see on Range Resources, another good gainer for us. It got positive at 5 and keep going. Buy it against the red, buy it against the red. Again, you were buying it against the red. So as long as it stays above 25 bucks, it seems like it might have a reasonable chance of going up. Let's see on a short-term basis if it looks like it's rolling over a bit. No, you see that 27 bucks to 25 bucks. That's where we're thinking it might not get underneath. If it does, then the story's changing. When the story changes, you got to change. So there's a couple of things. Now let's take a look at China here, because if they reopen, it's a big dragon out of the cage, right? So let's look at FXI and see where we would want to get involved with old China. Okay, we got a buy signal here on the 1-year at about 22, 23. So it's at 25. That's not that far away. Could pull back, right? The red and the green are all underneath the blue. The last time that happened was August. Obviously, it didn't end well. So again, when you're going to make a lot of money in something, all three of them seem to be going in the same direction, right? That's not happening yet. Okay, so this could be a false breakout and more work to be done, more wood to chop, as they say. Here again, nothing but resistance above. So it might be a little early to get the party hats out on China. And then on 20-year, a reversion to the mean trade. Okay, reversion to the mean. So we do have a signal that said get in around 23. And so as long as it stays above that 23 area, that's something to hold on to. And it does have a reversion to the mean potential. How about those tech stocks over there? All right, so this doesn't go back very far, so we're only going to go 5 years back. And you can see, again, it's getting above 24, which is a positive. And then if it can get above 27 and a half, that would be more positive. So 25, 27 and a half. Again, like to get that red line pointing up, because these rallies, when it doesn't point up, fail. Rally doesn't hardly go up, fail. You want it to look like this thing here. You see when it rolls straight down, how long that goes? Woo, right? So again, over here, point straight up, wham. So if you're trying to make some money, you really got to have the red line pointing in your direction with a pretty good conviction. That's my long and short of that. And then, of course, this is my throwaway, forget about it, and see if it'll come back and be a big gainer. And this is the ride sharing DD. And again, we were interested at $1.50. So far, so good at 244. But again, yeah, it's only a $2 stock. But again, that means all you can lose is 244. So it's like buying an option that doesn't expire, right? You'll always own it until they go out of business or it goes off the exchange. And you can't lose more than 244. Like when we were talking about it at 150, see where it gets above 150, that's where we got the signal. And then where could it go? I don't know. If, like I joke, 6 billion people get out of their apartment, somebody needs a ride, maybe these guys can make some money. Anyway, that's one that we thought might be interesting as far as being a cheap one is concerned. And that's pretty much it. Let's look at some of the staples that people are getting involved in. Financials, again, it's in the financials, Bank of America, JP Morgan, but this gives you the whole group. Again, the financials are part of value, right? And look at values doing well. So as long as this thing stays above 32, it's going to pay you dividends, and you're going to be happy you own it, right? Okay. On the other one is the industrials. And again, you can go into the top 10 holdings of this stuff. You'll see exactly what they own. But again, it's in the above the blue, and you're getting paid a good dividend. So as long as it does that, you're going to be happy to own it. And then materials, SLB. SLB, XLB. There you go. All right. On the materials, same story as the other, I think. Let's see. Yep. Yeah, you're above the green line. It pays good dividends. So you understand what I'm talking about? I'm talking about having, an asset allocation mix that makes sense. Yeah, like Wayne Gretzky says, you want to go to where the puck is going. In the next few years, there's going to be rampant speculation in the high PE ratio stocks. Is that what's going to happen in the next 12 and 24 months? Is that really where we're going? Or are we going to a situation where oil might become a much bigger percentage of the S&P? It was at 2 and 3%. It's now at 6. Some people are saying it's going to jump to double digits, way into double digits. If that's going to happen, these are the kind of things where the money is going to be setting down. Some of the staples are quite expensive, so they haven't been quite as good. But your utilities, which pays nice dividends, and again, they may have to increase their dividends to compete with the higher treasury yields. Again, this is getting right back above the line here as well. So as long as it's above 65, you'll be okay. And it pays a good dividend. And then the other is the staples, your Colgate Palmolives and your Procter & Gamble's and your Coca-Colas and stuff like that. You can see on that, let's go. Oh, how did I get to a 6-month graph? Hang on a second here. And I'll just show you this one last thing here. Here we go. XLP. Again, these are a little bit higher. Oh, actually, the staples are going to look a lot like the other value ones. Let's look at something that is turning down a little bit, and it's surprising people. I'm going to get to 2 more quick ones, then I'm going to close it up. All right. XLV is healthcare. Okay. Healthcare now up a little bit today because you're looking at a situation where the dollar has switched back and the interest rates are going back up. So they're going back into the defensives, which had a sell-off. And I'll show you that sell-off right now. This is the healthcare ETF. Okay. Now, again, it's been doing really good, but it had a bit of a pullback, but now it's back up on the bicycle. You can see just like that, just like all the value stuff, this is another area, pays good dividends, and it has what? It has good underlying strength. And so that gives you an idea on that. Okay. What I would like to do right now is, again, reintroduce the ability to get a hold of me. The website is option, OPTION, professor, PROFESSOR.com. Make sure it's singular, option. I guess there's other websites that have options. So option, singular, professor.com. And you'll be able to put your email information in. You can also email us at optionprofessor@gmail.com, your contact information. Here's something that we can make available to you. A PDF report on how to hedge against market declines and upside surprises. That is a very good PDF report. Again, since the 4,800, you think learning how to hedge against market declines would have been good for you? And what about last week? Having some hedge against that CPI report, would that have been helpful? Do you know how to do that? Have you ever done that? So that's why you get the report. Number 2, PDF report is on our technical indicators, how to read them, how to interpret them, how to put Fibonacci numbers and Elliott wave cycles possibly into them. And also, again, how to go with overbought, oversold. And we explain that in detail. And again, we show you how the indicators work.